All right, we're about to get deep into this section of price action here. So if you're having any struggles navigating the market, understanding why price is doing what it's doing when you're trading these intraday price action, this is going to clear a lot of that stuff up for you. So I do recommend going and grabbing some note-taking here because you're going to want to be writing this stuff down, right? This is going to be something you want to study and go back test because things are going to make a lot more sense when we're through with this lecture. So immediately, what do you see here, right? I see a market maker buy model. So in order to trade both sides of the market maker model, you're first going to have to understand two different draws on liquidity. So if we go to an hourly chart, yesterday we had FOMC, accumulation, manipulation, distribution. We left behind an hourly order block right here. If we drag that out to the right, label that as our order block, we can go back to our 3-minute chart, and we can see mean threshold is right here. We know that that midpoint, mean threshold, that's what we want to see get respected here. So what do we form? We form our consolidation here. The narrative for this market maker model is we're going lower in order to go higher. So how high should price go before we get the sell side curve? How far down should the price go before we get the buy side curve? You can see in this case, we're anticipating mean threshold to be respected and to sell off to our draw on liquidity. We have a consolidation down here, and this marks previous day's low, a clear and obvious draw on liquidity with all of these relative equal lows and a daily low resting right here. So we're going to remove this from our chart here. Now what we're focused on is the market maker model itself. So right here we have our 930 open. We trade up into this area of fair value, we touch this order block to the tick here, and we begin our move lower, taking our Judah swing all the way down to previous day's low. This is your low risk buy of your market maker model. You can see here we have our second stage accumulation, and that brings us straight down aggressively to previous day's low. So what is this? This right here is your turtle soup entry. Why is that a turtle soup? The narrative is we are going lower in order to go higher. If you know where the draw on liquidity is, this is a valid turtle soup. You take your entry, you wait for price to displace because it's not a valid turtle soup if price does not strongly and quickly move away from your entry. If it continues lower, you'd simply close the position out and wait to get on the right side of the marketplace. In this scenario, this is a valid turtle soup at previous day's low. This marks the change in the state of delivery where the sell program transitions into a buy program. So where's that order block? It's right here. This order block should not be traded under. If you took this turtle soup and we get this displacement higher, it is safe and reasonable to trail your stop loss below the low of the candle that formed the order block. So let's label that as our bullish order block. And now what do we have here? Again, we have our low risk buy in this fair value gap here. Notice how the bodies are respecting the fair value gap and the wicks are wicking into the order block and returning to this fair value gap before closing. That is exactly what you want to see. We have a sell side imbalance, buy side inefficiency that is traded through. What does that turn into? Right? We have the same thing right here on the sell side of the curve. When you see these traded through on a closing basis, you can then anticipate this acting as support for the buy side curve. This is how the market maker models operate. If you want to know which fair value gaps will act as inversion fair value gaps, reference this market maker model right here. Label that as our inversion fair value gap. So now price has a reference. We're going to be referencing the sell side curve as we're forming this buy side curve. And what's important to note is equilibrium. When in a buy program, you're going to want to write this down. when we are in a buy program and we trade above equilibrium, equilibrium is now going to act as your discount. I'm going to say that again one more time. When we are in a buy program and trade through equilibrium, that equilibrium price point is now going to act as a discount. That means that you're going to be treating PD arrays like fair value gaps and order blocks as discount arrays if they are near equilibrium when we are in a buy program. The same thing is true if we are in a sell program, just flip the logic. So what do we see here? We have our turtle soup entry. That's your first opportunity to get long. We have our low risk buy. You can enter either in this fair value gap or in this order block. That is going to be your low risk buy. This is also seen as our first stage distribution. We displace out of that and consolidate. This is our second stage redistribution. When we're coming out of that second stage redistribution, you want to see quick and sporadic movements straight to that original consolidation liquidity. So I'm going to mark out our equilibrium price point here, and I'm going to remove this Fibonacci. I'm going to label this equilibrium. So now, knowing this information, maybe we missed this entry or we didn't have enough risk to put on our stop loss. Maybe we missed this entry, maybe we missed this entry, maybe we missed this entry. Second stage redistribution is the move you want to be in. It's going to be quick, sporadic delivery straight to your target. That's what you want to be in. These are the low resistance liquidity runs we're looking to engage with. If we extend this outright, you can see that this right below equilibrium, as well as the order block formed here, this series of down close candles, this is now going to act as our discount PD arrays. These two PD arrays are now considered a discount. Why? Because we traded above equilibrium in a buy program. We know the draw on liquidity is our initial consolidation high. This is going to be our market maker buy model terminus, right? This is where the market maker buy model should end. This is what you're targeting. Now, you can use PD arrays on any time frame, right? Right now we're looking at a 3-minute. You could jump to a 5-minute. And this right here, what is this? This is a bearish fair value gap. It was traded through. Now look at these wicks right here. What is it referencing? It's referencing the opening price of the sell side curve inefficiency. And we're using it as a reference on the buy side curve. I'm going to zoom in on these wicks here. Notice how the wicks are stopping right at the top. This is what we're referencing. So what does that make this? An inversion fair value gap. You have your institutional order flow entry, Joe, right here. Drop a tick into that fair value gap, followed by immediate displacement higher, small retracement, and again, immediate displacement higher without returning to this reference point here. Where does that take you? To that original consolidation high. This is in every single swing on every single time frame that you see in the market. I'm going to remove all of these drawings, and now we're going to add the time element. We know the market operates in 90-minute cycles. Using the power of 3, we can divide that down into fractal 30-minute cycles. So first we're going to mark out New York open, lunch, lunch end, and now we're going to start dividing these into 30-minute time frames. So here we have our first 30 minutes. I'm going to make this a dashed line. Next 30 minutes here. Next 30 minutes here. $10.30s right here. $1.30 and 2 o'clock. Now we're going to get real detailed. We're going to drop down into a 1 minute chart and analyze each of these cycles. And now we have our macros overlaid on our charts. Every hour there is a macro. This is something else you want to be writing down. Every hour there is a macro. Now this is something I want you to pay attention to. The macro is the transition period in between these cycles where the price will reprice to a premium or discount array in order to continue that move. Now I want you to see how precise and detailed we can get when we combine the aspects of the market maker model with the time element. Here we have our New York session open macro. Okay. These macro time slots are going to fall in the last 10 minutes of each hour, extending to the first 10 minutes of the next hour, right? And you can break this down. Like I said, price is fractal, so are the time elements. You can break that down into 30-minute cycles. Then you have a transition period every 30 minutes using that same logic. The last 10 minutes of your 30-minute cycle, followed by the first 10 minutes of the next 30-minute cycle. You could see the times delineated right here in these boxes. So let's go into Market Replay and take this bar by bar. So we have our New York open. We get displacement to the downside. Now we want to see, will a fair value gap form? It does. If this fair value gap is traded back into, where is our entry? Our entry is going to be inside of this fair value gap, and our stop loss is going to be above this high. Play the next bar out. We get that. We can sell that short here. We can take our stop loss, simply put it above that previous swing high. Now we want to see displacement through this up close candle. Now, what did we just leave behind right there? A fair value gap. If that is repriced to, you can add on to your position. But in this scenario, you don't want to see the entire gap filled. Why don't you want to see this particular fair value gap filled all the way? We want this to act as our breakaway gap. A breakaway gap is a gap that is not fully filled because price is in a hurry to get to that sell side objective. So we're going to mark out this fair value gap, extend it out to the right. Now we're looking at this consequent encroachment level here. We want to see price stay below that consequent encroachment level. Right? You can see we get one tick below consequent encroachment there. Displacement lower. Right here, consequent encroachment to the tick. That's followed by displacement lower. So now what do we want to see? We want to see more displacement with more fair value gaps. We see a fair value gap left behind already, and two fair value gaps left behind right here. So we're trading into this first fair value gap now. What you can do in this scenario when you have a range, take your fib from high to low. Now you've divided this range from a premium to a discount. We have a discount array here and a premium array here. The most likely scenario is we trade up into this premium, leave a portion of this unfilled, and begin displacing lower. Why? Well, if we jump to our 5-minute chart, we have an order block. Denote that on our higher time frame and translate that to our lower time frame chart. In this scenario, we want this to act as our breakaway gap. You can see we just dip into that premium. We have our order block level here. We want to see our order block and above remain unfilled. That's a confirmation that you are still on the right side of the marketplace. Now look what this macro does. This macro reprices to a premium of the short-term range into a PD array right here, institutional order flow entry drill. We trade one tick into it. This is left behind as a breakaway gap. This macro is active. This is the first portion of that macro. The macro repriced to an inefficiency. So what can you expect the latter half of this macro to do after displacing away from it? We're entering our new 30-minute cycle. The algorithm is active inside of this macro. Using that logic, we can take our Fibonacci, take our standard deviations from body to body, and we look for a price that is in alignment with our objective. Algorithmically, if we're operating in standard deviations, this is the first standard deviation level below our liquidity. So how far should it go through the level of liquidity? 3.5 standard deviations. So I'm going to go in, I'm going to disable the rest of these here. Now look at this market structure here. First stage, accumulation. Second stage, accumulation. We know that that second stage should be a quick and sporadic price run directly to our target. We know this macro is active. The first half of the macro repriced to a premium in this range, leaving this breakaway gap. We are displacing, we are entering our next 30-minute cycle. Time and price are in perfect alignment here. So what we want to see now is quick movement. Just like that, we want to see that move all the way down to this sell side right here. We reprice to that imbalance, displace below this low, and we hit our price target. Where does that low form? 3.5 standard deviations. Guys, this is not random. This could be your turtle soup entry. So now we are anticipating this to be the end of the sell side curve and the beginning of the buy side curve. So using that logic, what should follow? What happens when a sell program turns into a buy program? Now you're looking for a change in the state of delivery. Now there's something else I want you to notice. What time was this hit? The last minute of our macro. Our macro ends as we hit our objective. Now following, we're looking for displacement higher and an order block to form. All right, now we are in our next macro. What do we anticipate to happen? First stage distribution. So now this is where we can take our Fibonacci from high to low of the range and divide the range into premium and discount. Now we're looking for a move to that equilibrium price point. Do we have a PD array at or near equilibrium? This fair value gap right here, right? We have two fair value gaps. So you can pick either one of these. To be in the safe scenario, pick the one closest to equilibrium. Now we're going to draw that out, and we're going to use this as our premium array in this 30-minute cycle. So now let's establish the framework we have right now. Change in the state of delivery, reprice to what? Fair value gap. If we draw this out, do we stay above consequent encroachment? Yes, we do. That means you're on the right side of the marketplace. So what can you do? You can take a buy, set your take profit right inside of that premium array. Take your stop loss below the previous candle that formed that fair value gap. Now our macro is active. We're in the last 10 minutes of this 30-minute cycle. What we would now anticipate is the macro repricing to an inefficiency, staying above that midpoint because we want to see that act as a breakaway gap, And we want that to reprice to a PD array at equilibrium inside of this cycle here. So let's continue taking this bar by bar. We get that displacement higher. We take out this swing high. So now the market is demonstrating bullish institutional order flow after leaving a breakaway gap. And just like that, we hit our target. So now we're starting our new cycle. What do we anticipate happening now? What did we leave behind? An area of fair value. So what are we anticipating now? We're anticipating this to retrace into this area of fair value, and that's going to act as our leg of bullish reaccumulation. This is where you want to see your first stage reaccumulation start. You see, we do go a little bit higher into this fair value gap right here. And this macro begins to take us lower into this area of fair value right here. So now, what happens in bullish institutional order flow? In bullish institutional order flow, we break highs and we respect lows. We have a change in the state of delivery with a breakaway gap. So that means this low should not be broken. Using that logic, we can buy right here, take our stop loss, set it below this low. What are we going to use for our take profit? Well, now we're going to be looking at premium arrays. We see we have one swing high right here with a fair value gap that was used as a breakaway gap earlier. We also have this fair value gap that was also used as a breakaway gap from earlier. So now we're in a position with two take profits. If you only have one contract, take the low-hanging fruit, the easiest target you can take. If you have two contracts, this would be a scenario where it would be acceptable to take risk off at this one and have your final take profit right here. Then we'd anticipate what? Second stage redistribution. Why would we anticipate it there? What do you see here? What did price manufacture? Liquidity. Retail traders who are in short see this as a level of resistance. Price should not go back above here, therefore what's resting? Limit orders. Limit orders in the form of retail traders' stop losses. Again, right here, what do we have? 1, 2 relative equal highs. What is now manufactured here? All the retail shorters trailed their stop loss above this high. Anyone who saw this as a retest, who sold short here, have their stop losses above this high. That is what we're going to be targeting. So just to quickly recap our framework of what's going on. We are now on the buy side of the curve. We're anticipating our first stage bullish reaccumulation in this area of fair value. When we have bullish institutional order flow, we break highs, like this high here and this high here. And we leave lows intact, like this low here. So now we're anticipating this low not to be broken, this area of fair value to act as our area of bullish reaccumulation, and we're anticipating this next macro that's going to start in this transition period to take us where? Above equilibrium into a premium array. So let's continue to play this out bar by bar. See, now we're in our macro. So now what can we anticipate? We can anticipate this macro to take us to our initial price target here. Right there. Look at that. Our order just got filled. Did we leave this swing low intact? Yes. Did we take out these relative equal highs? Yes, we did. We are remaining in bullish institutional order flow. So just to clean this chart up a bit, I'm going to mark out our equilibrium price point, and I'm going to take away this premium and discount so we can get our nice clean chart back. So now we are in a premium. What did I say about trading into a premium? Hit that second price target right here. What did I say about trading into a premium and the relation of equilibrium when we're in a buy program? Said it at the beginning of the lecture. When we are in a buy program, we're anticipating equilibrium to now act as our discount. That means we want to be looking at PD arrays at or near equilibrium to propel price higher and act as a discount array. We want to see that act as support for price. So let's clean this chart up a bit. What did I say earlier? What will we be referencing on the buy side of the curve? We'll be referencing sell side PD arrays at or near equilibrium. Yes. Sell side PD array. Yes. Extend that right. Anticipate that being referenced as an inversion on the buy side of the curve. Let's mark that as an inversion fair value gap. And now let's continue playing this market maker model out. This is going to be your buy for your second stage redistribution. We can buy this using the same logic as before. Look at this low here. Again, when we are in a buy program and demonstrating bullish institutional order flow, lows will not be broken and highs will be taken. So we take our stop loss, drag it below the previous low. So what do we target during second stage redistribution? We're targeting our initial consolidation highs. You could see that clear as day right here. 2 equal highs at the beginning of our consolidation before this market maker model starts to develop. All right, and now we've entered New York lunch hour. Typically during New York lunch, you do not want to be trading. Retail traders are taking a break. There's a reduction in liquidity, meaning there's a reduction in the amount that the market can actually move, right? If you're in a position going into lunch, that's perfectly fine. What you don't want to be doing is entering a position during that lunch hour, because what you're likely going to occur is time distortion. Now, if we're in a different scenario where we're not looking at a clear market maker buy model, the lunch macro likes to target AM session liquidity, right? Using the context and narrative of what we're looking at in the charts now, it would be reasonable to anticipate time distortion until that New York PM session open and a return of liquidity is injected back into the marketplace, and the market now has areas of liquidity to begin spooling towards. So let's just keep playing this out. Let's extend this out a little bit. You can see we touch that inversion fair value gap one more time. Touch that inversion a third time. Trade below it, but look at the bodies. It is perfectly permissible to see these wicks. We just want to see the bodies close inside. These wicks right here, this is what we call mohawks, right? Little deviations in price, and that's especially permissible on tickers like NQ, where price likes to over-deliver, right? Color outside the lines a little bit. What you want to be focusing on are those bodies closing inside. All right, now look at this macro. This macro is now beginning, and it's the last 10 minutes of lunch, and it's going to be taking us into the beginning 10 minutes of that PM session open. This is where we want to see the move begin to resume. Look at this. We're crossing that line. We're now in a new 30-minute cycle where the algorithm has a new set of instructions paired up with this macro. and we're spooling higher. This macro ends. Where's our next macro? Look at this next cycle. 10 minutes beforehand, this is where our next macro starts. What do you think is going to happen here? Do you think we're going to retrace into this fair value gap? Or do you think we're going to send price to our objective? Remember what we talked about earlier with fair value gaps. Right? Look what we're getting here. Displacement higher. What did we not trade back to? Consequent encroachment. That is the best sign you can get. That means you are still on the right side of the marketplace. We are in the PM session and the algorithm is still intending on taking out that buy side liquidity. And just like that, our order gets filled. So let's remove all of this from the chart. Let's recap what happened, right? Just a quick overall recap of everything we learned today. A market maker model has two separate draws on liquidity. Manufacturing liquidity at our initial consolidation, taking out our sell side, demonstrating a change in the state of delivery, and then beginning to spool back towards that initial consolidation, taking out sell side, taking out buy side. How do we know we're on the right side of the marketplace? There's two different ways. You can look at your institutional order flow. On the sell side curve, we want to be breaking lows and leaving highs intact. You can see we're breaking lows, leaving this high intact, breaking that low. We're going to be leaving this high intact, breaking this low, leaving this high intact, all the way down to our sell side liquidity, where we anticipate what? A change in the state of delivery, where the sell program transitions to a buy program, which is accompanied with an order block. Where's that order block? Right here. Price should not trade back below this level. Not only is that an order block, but now we're anticipating bullish institutional order flow, where we're breaking highs and leaving lows intact. So we have a turtle soup entry. Now we're anticipating our low risk buy or bullish reaccumulation. We leave this low intact, displace higher, and break this high. Now we are above equilibrium. So what is equilibrium now going to act as? A discount. So what do we look for? PD arrays from the sell side curve near equilibrium that will be referenced on the buy side curve as a new discount PD array. This is algorithmic price action. This is how the markets are booked. This is how price is offered. It's not random. What do we return to? Inversion fair value gap from the sell side of the curve at equilibrium that is now being referenced as a discount. We get our lunchtime time distortion, PM session open, second stage redistribution right here, takes us quickly back to our initial consolidation highs, taking out that buy side liquidity. We're leaving breakaway gaps here, 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 here. There's no better sign that you're on the right side of the marketplace than if those fair value gaps do not get traded all the way through or not to that midpoint. The less it trades into that fair value gap, the stronger price is going to move in that direction. I'm going to say that one more time. The less we trade into the fair value gap, the stronger price will move in that direction. Now, there was a lot of information, and we're combining a lot of different concepts here. If you didn't take notes the first time, now you have a foundation. Watch it again, take notes on your second time around, go into this price action, and look at how it's operating. Study these market maker models, because the market maker models will add narrative and a reason for price doing what it's doing to every single one of your trades. You could take it a step further, combine it with price. Now you know when things should happen and why things should happen. Look at these executions. Yes, this is market replay mode. Of course, it's going to be more difficult when you're seeing it live. That's why we study. That's why we take notes. That's why we backtest. So that when these opportunities do arise in live price action, you can act on them. You can capitalize off of this. Notice how I'm selling and buying one contract at a time. With one contract, playing this market maker model, $8,190. Is that enough for you? Is that enough for a day? Is that enough for a week? Is that enough for you for the month? If you can get one good market maker model a month, and you can capitalize on it like we did here, is $8,000 enough to make you happy for that month? Is it enough to make you happy for a week? Understanding that opportunities like this exist in the market, that mitigates that want or that need to go in and feel like you need to trade every day. If you're able to begin capitalizing off of moves like this and understanding time and price and how they connect with each other and how narrative is going to drive the market, you only really need to trade one day a week, one day a month, whenever you are dialed into the market in a way like this, where you know time is in alignment, price is in alignment, institutional order flow is on my side. If all the boxes are checked, that's all you need to do. That's all you need to wait for. If it's not there, then don't take it, because these are the results you can experience when you begin letting go of that need to trade all the time. When you stop looking for setups in the chart and you begin waiting for those setups to jump out to you, that's when you're going to become the most profitable you can be. So go back, review your notes, take some extra notes if you need to. If you didn't take notes the first time, trust me, go back and take some notes. Back test this in your charts, forward test it on paper trading. Then you can move into your, combine, funded account, personal account, whatever you're trading with. Make sure you can understand this and replicate it on your own before going in and trying to use it in your account. And as always, until next time, stay safe.